In this episode, interest rates are on the rise, and we break down what it means for you. Hey everybody, I'm Mike Desepoli, and this is episode 26 of the Ask the Advisor show. Well, they did it again. The Federal Reserve raised interest rates for the second time this year, and we're going to break down what it means for you. But before we get into the details, first the what and the why. What is the Fed doing and why are they doing it? Well, if we go back to the fall of 2008 when the economy was on the verge of collapse, one of the primary tools that the Fed and the Federal Reserve, who controls all monetary policy in the United States, one of the primary tools that they utilized to try to stimulate growth and stem the slide of the economy was lowering interest rates. Conceptually, lowering interest rates should stimulate growth through the forms of different loans and financing, and hopefully will pull us, or at that time they were hoping would pull us out of the Great Recession. You fast forward 9 years later to 2017, and as the Fed has monitored economic growth over that time, obviously we've grown a lot over the last 9 years, and it is now their responsibility to raise interest rates to keep pace with the growth of the economy. Obviously, everybody gets used to cheap and low interest rates, so when they start to raise them, they need to do so in a gradual and systematic manner that they don't upset the markets. So that's where we sit here today, and as of last week, the Fed rose interest rates for the second time this year. So what does it mean to the individual consumer or the average investor? Well, it's going to affect you in a couple different ways. Nothing catastrophic, of course, but we just want to lay it out so you could be prepared. First, mortgages. If you have a mortgage and you have a fixed rate mortgage that you're locked into already, do not be concerned with interest rates movements whatsoever. However, if you are a prospective buyer and you're looking at properties, you're likely going to see mortgage rates start to inch up a little bit. When the Federal Reserve adjusts what they call the prime rate of interest rates nationally, it affects all different lending institutions and the loans that they write. So mortgages obviously is one of the primary things that will be affected. For those of you that have a mortgage that's an adjustable rate mortgage, obviously you don't want to see interest rates start to increase more and more, because at some point, whatever period that you have set for readjustment, you're likely going to see your loan readjust to a higher rate. On a personal level, personal loans, business loans, auto loans, car loans, those rates will also start to increase as the Federal Reserve increases the national interest rate. Again, they're doing it incrementally. This most recent increase was by 0.25%. Okay, so you're not likely to see these rates jack up by 5% overnight. However, we will see over time them moving to a higher and more normalized rate. Bond investors. All right, this is the dirty little secret about bonds. Many bond investors associate bonds with stability and income. However, there is one risk to bonds and to the value of bonds, and that's movements in interest rate policy. Bonds and interest rates tend to have an inverse relationship, meaning as interest rates increase, prices of bonds decrease. Now, why does that happen? Well, the primary reason for that is as interest rates rise, new bonds are being issued that pay more annual income than bonds that were previously created in years past. So if you own a bond that pays you 4% per year, and a new bond comes onto the market that's paying 5%, everybody wants the 5% bond, and your bond is no longer as attractive as it once was, which causes the prices to go down. So that's something for bond investors to keep an eye on. Obviously, there's many different types of bonds out there, so we don't want to, drive any fear out there. Some people have bonds that will adjust with interest rates over time, and then you should not be concerned with movements in interest rates relative to your bond pricing. So those are just a couple areas that we think interest rates and increasing the interest rates will have some effect on investors and consumers. Obviously, it's much more wide-reaching than that, but we just wanted to break down a couple key points here today. Thank you so much for tuning into this show. If you're watching this on Facebook and you like what you see, please throw us a like. We'd love to get some feedback from you. We really do this so that we can try to generate as much financial education as we can. And if there's any topics that people want to hear us talk about, we would really love to hear from you and share your feedback with us. YouTube, please subscribe to our channel on YouTube. We really appreciate you tuning in. And if you subscribe to our videos, you'll make sure that you never miss a future update. If you're on Instagram, check us out at Ask the Advisor. We post a lot of really interesting stuff there. Motivational Monday, Entrepreneurial Tuesday, Wealth Wisdom Wednesday. So stay in tune with us on Instagram if you're on there. Follow us and make sure you never miss an update. And of course, Twitter. If you're on Twitter, you can send us a question of anything that you want to ask us in the investment community using the hashtag #AskTheAdvisor. You know, this show has really grown a lot over the past couple months, and we thank you so much for your support. But we can't forget where we started. We did originate on Twitter with some of our original questions coming in from there. Thanks so much, guys, for tuning in. We'll see you back next week with episode 27.